All right, we are moments away from the official start of trading, 22 seconds to be exact until those bells really ring and trading opens up on this Friday. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld. You take a look at futures right now, pretty much green. You can see that across the board from big to small, which is amazing when you think about the volatility that we've seen in the past week, in the past month, really all summer long. But it looks like we're going to close out this trading week and this trading month with more gains on the screen. You can see, of course, the companies at the NASDAQ and at the NYSE's clapping right now, of course, as trading officially kicks off on this final trading day of August. You take a look at where the major averages are trading right now. Officially, we can say we do have green on the screen. The S&P 500 currently up to the tune of 0.5%. Even more so if you take a look at big tech. We had a really weird volatile day yesterday with NVIDIA's fluctuations, but right now up by 1%. And the small caps also getting in on the action. The Russell 2000 currently up about 0.4%. Now, one stock to keep an eye on at the open is Intel. Remember that Bloomberg News reporting the company is discussing various scenarios with investment bankers as it struggles to appease investors. It may split its product design and manufacturing businesses, as well as put some factory projects on hold. This is according to people familiar with the matter. You take a look at the reaction in shares right now, and it seems like there's an embrace of that possibility. Intel currently up about 5%, Shanali.
A few other stocks we're watching as the market opens here. Marvell Technology up more than 11%. This chip maker is soaring after strong second quarter results and a promising revenue outlook. Analysts are noting that demand for AI products for this company is fueling growth. And Lululemon higher despite lowering its sales and profit outlook for the year. The company cited increased competition and inflation, but analysts say the guidance cut was already baked into the share price, and you now have Lululemon up more than 2% as the market opens. And for more Lululemon, we're going to be joined by Poonam Goyal, Bloomberg Intelligence senior analyst for e-commerce and athleisure. And it's interesting, if you look at the headwinds, yes, maybe they have been baked into the price here, but are there perhaps headwinds that the market is not seeing that could meet this company in the coming months?
Sure. I think, what we really need to focus on here is the product. So they talked a lot about traffic being positive both online and in stores. So it's the conversion that fell short. And that was due to missteps in women's where they didn't have the right silhouette. They didn't have the colors, the patterns. So really what I'm watching for over the next 3 to 6 months is that reintroduction of colors, silhouettes, patterns to see if the consumer is responding. And if that's the case, then I think, they'll continue to move forward. But if we don't see that, I think there could be more missteps leading to possibly even lower results.
Poonam, I was saying to Shanali before this block started that, full disclosure, I really like Lululemon. I really like Peloton. I use both of those brands very frequently. I know you don't cover Peloton, so I won't ask you, but it's interesting that you do have all of this brand recognition when it comes to both of these companies, and yet you take a look at the stock performance, you wouldn't necessarily know it. And to your point, when it comes to the branding and the silhouettes, et cetera, you have Jefferies out with a note saying that maybe the brand has peaked now. Maybe style is shifting. And you think about sort of the re-embrace of baggy jeans, et cetera. I mean, how difficult is it for Lululemon just to keep up with current fashion trends?
Well, they're trying, right? So they're trying to go beyond that aligned legging, right? They're introducing baggier fit, more casual fit in men's and women's, and it's going to take time. That's not what Lululemon is known for. They're known for that wear to the run. That's what you're wearing to the yoga studio. That's what you're wearing to the gym, but not necessarily when you're just hanging out with friends or going out. So they're trying to change a little, but I wouldn't expect them to change too much. I think there'll be a balance, but the customer does love the brand, to your point, and I think that's the one thing that's going great for them. It's if they get the right product, I think they'll do just fine. It comes back down to product.
Very hilarious that you say that, because I was just telling Katie that my spending power has moved, and I love Lululemon as well, from Lululemon leggings to cowboy boots this year. But at the end of the day, another thing that I'm interested in here, you had Lululemon, for example, invest in different things, right? Like footwear. But at the same time, you see brands like Abercrombie and Fitch also moving into that athleisure category. Are they just facing more competition for this lifestyle brand that is attracting attention elsewhere?
Yes, so definitely there's more competition in the competitive landscape. But that said, I would also say that athleisure is growing as a whole globally too, right? Whether it's international or here, more people are more active. They are going to the gym more. They are spending time outdoors more. So it's a category where everyone can gain share, but competition will be tougher as everyone, not just Abercrombie, but even the Amazons, the Walmarts, the Targets, Alo, you name it. It's coming from everywhere, high to low end.
All right, Poonam, really appreciate your time. Of course, Poonam Goyal of Bloomberg Intelligence talking about Lululemon down just an absolutely punishing 49% year to date. We're going to continue to follow that story. But let's broaden out this conversation now with Adam Hetz. He is global head of multi-asset over at Janus Henderson. And I won't ask you about Lululemon, of course, and whether you shop there, but I do want to talk about market fragility, because back in June, you highlighted that risk factor and you said that a 10% correction is more likely than not. You think about July, you think about August, and all the volatility that we've seen. Are we past the worst of that correction?
Well, morning, Katie, Sonali. And I might have a little bit of Lululemon in the closet, but moving on back to my last time as a guest in the show, and thanks for having me back. Yeah, that was mid-June. I talked about the fragility in the market. To your point, I talked about the likelihood of a 10% correction probably being more probable by the end of the year than not, but still thinking we'd end positive for the year. And then mid-July, that fragility in our view translated into that 8.5% drawdown that finished off early August. So our view at this point is the market did pass a bit of a test. We like 5,600 a little bit better this time around, but with this round trip that we've had, we're also back to a lot of the fragility that drove that sensitivity that triggered that pretty abrupt drawdown that we saw in mid-July.
So we're standing here the last trading day of August, and everyone's coming back from a Labor Day weekend next week, and you have a new setup, one where the election is around the corner, one where a little bit of leverage has been popped out of the system this month. So how do you expect the story to go from here? Who's going to be investing in the market when we come back, and how will they be investing in it?
Well, on the note of coming back, it's nice having the data print this morning as far as PCE and the consumer. I think we can check that one off. It's a nice print going into the long weekend. And then now we're looking forward to a week from today with NFP, the non-farm payrolls, the 11th CPI. That leads up to potentially historic decisions on September 18th. So our base case here is that the S&P should and could just grind higher from here. And most investors will continue this broadening trade that's fueled by a solid GDP, the broadening into better earnings. But I think there are a lot of risks out there that we have to remind ourselves we are in this late cycle environment. For example, earlier in the year in our model portfolios, we saw more of a mid-cycle true re-acceleration in the economic data. So we broadened our portfolios down in cap, international, more of those cyclical markets. At this point, we think the bar's a bit higher to add risk from here. So we want to see how this Goldilocks narrative ensues from here. And if that's challenged again whatsoever, that fragility across earnings expectations, where current valuations are, it could drive another drawdown before the end of the year.
Well, let's talk about where we are in the calendar year as well, because if you crack open the Stock Traders Almanac, September has been the biggest percentage loser for both the S&P 500 and the Dow Jones since 1950. You think about those risks ahead that you neatly laid out for us. Are you expecting history to repeat itself here when it comes to the seasonality effect?
Well, maybe I can do you one better on history lessons. If we're going back to the 1940s on GDP, as we were thinking about that 3% GDP print last quarter, we don't think there's a whole lot of forward-looking guidance in that. We like that we're not seeing fractures or cracks in the surface and the foundation we're all standing on with the economy. But average GDP going back to the 1940s before a recession, the quarter before a recession was 2.7 real. So that gives you the appropriate grain of salt as far as interpreting GDP. So I think you're talking about September going forward, going back to Goldilocks, there's a lot baked into market expectations right now. And we have multiples 10, 20% above historic multiples, never mind how far above we are recessionary type multiples. Again, that goes back to this being a nervous market, laser focus on the data. We had the smallest hiccup on NFP, on CPI. To your point, that could drive a weak September. That's not our base case. Again, our base case is S&P continues to grind higher, but we're on guard and we're being cautious and we're watching the data very closely, of course.
I also want to talk about sectors a little bit here, because you look at the month to date, it's pretty fascinating what you're seeing in terms of investor flows here. You do see some of that broadening trade occurring. You do see consumer staples, real estate, financials, utilities, healthcare, all doing better, but energy and consumer discretionary really lagging behind. When you look at September, do you extrapolate from this? Do you see more of this, or do you see some reversal in some degrees?
Good question. I'm glad you're getting into sectors beyond just technology. And so we like that broadening trade. That's very satisfying as a portfolio manager as far as the impacts that has on a well-diversified portfolio and long overdue. You talk about energy, talk about discretionary. That's another good reminder that we are in this late cycle environment. Late cycle can go on for a long time, and that's the base case again. But you're also seeing these pockets of weakness in some places. I wouldn't extrapolate that too far. When we're looking at this broadening trade, GDP, earnings, the broader sentiment, optimism on rate cuts. What we're seeing here is Russell 2000s beat the S&P over the last 3 months. That's phenomenal. Even over the last month, you've even had international developed, the MSCI EFA index, beating the S&P over the trailing month. So that's wonderful to see in portfolios that the sort of baton is being passed from the AI trade and tech trade into the rest of the broader market, not just U.S., but internationally as well.
Adam, we thank you so much for your time. That is Janice Henderson, Global Head of Multi-Asset. Adam Hetz, have a great weekend to you. We're going to take a look at some movers this morning because, yes, we are up on the S&P 500, but certain stocks are certainly down on the day. Lululemon in particular, we were talking about it. People had thought here that the cuts were really priced in, but now we're seeing the stock lower by 1.7%. MongoDB just on a tear, Katie, up more than 17% today after promising earnings results here. You are seeing very interesting movement in the tech sector. I would also note, not on this board, Dell as well, flying higher. Ulta Beauty now down 4.4%. I know you were watching that. We both love to buy makeup. And so obviously Berkshire Hathaway has loved to buy Ulta as well, but not feeling the love from that stock today.
Definitely a summer Friday with Shonali and I just going into our spending habits, but definitely some interesting movement there at the single stock level. And coming up, it's being called one of the strongest turnarounds in retail history. We'll tell you what CEO is being credited for the positive pivot in today's top calls. This is Bloomberg. All right, it's time now for top calls. Some of the analyst action in focus this morning. And first up, Citi upgrading Abercrombie & Fitch to a buy. The analyst says that Abercrombie had one of the strongest turnarounds in retail history, adding that CEO Fran Horowitz has shown she has her finger on the pulse of their consumer. We spoke to Horowitz earlier this week about the turnaround.
We've spent a lot of years transforming this company and really rebuilding our operating model. And we've spent time and time again with the investors really explaining and helping them understand what all of that means. What that means is staying close to your customer, making sure that we're reading and reacting to the business, having financial discipline and how we control our inventories. It's a new way of thinking about retail, and our operating model continues to drive results.
And next up, Morgan Stanley says that Dollar General is no longer a buy and shaving its price target by $70. The analyst says that there is greater uncertainty around whether the discount retailer can stabilize its market share position. Dollar General reported bleak second quarter sales weighed down by a weaker low-end consumer. And finally, Raymond James cutting its price rating, its target on Ulta Beauty to outperform and cutting its price target by $50. The analyst citing the impact of competition and a softer macroeconomic environment. Ulta trimming its sales forecast as more consumers cut back on cosmetics. And let's discuss this now with Bloomberg's Afanasieva joining us. And I'm really curious about just the context and the contour of this year, because in the first quarter, it seemed like beauty was where you want to be. And obviously, you take a look at the shares since then, and something has changed here.
Absolutely. Yes, it's both a structural change and a change that's Ulta specific. On the one hand, you've got consumers trading down and spending less and experiencing weakness after a strong period of inflation and high interest rates. There's, of course, the dupes that we all know. Why spend a lot of money on a product where you can have the Walgreens equivalent with the same ingredients? They might not be of the same quality, who knows, but they cost a lot less. And then in Ulta's case, it's been complaining about having Sephora shops open, for example, in the same area. So they're having to work harder to compete for their piece of the pie because it's just such a competitive sector in beauty and skincare.
At the end of the day, when you look at the stock price reaction, down another 3% and bringing the year-to-date declines to almost 30%, Dasha, how much needs to change at this company to change investor sentiment around it?
I mean, it's rare to see such a sharp downgrade, and you sort of wonder how could things have changed so much in the last month that you're forecasting, a decline of sort of 2% rather than up to a 2 to 3% increase in sales for the year. So I do think a sort of a more radical overhaul is probably called for, or I'd be calling for it if I were an investor. But on the other hand, if part of problem is that there are Sephora stores close by, you can't very well overnight up sticks and leave and change the location of your stores. So I think that it's about a cleverer marketing strategy and definitely promotional activity, which of course will have an impact on margin. But I think that the company's got to unveil something that will at least convince investors that it's doing well in a tough market rather than doing poorly in a very tough market.
And I want to build on that conversation because you mentioned the competition and you mentioned marketing. And you think about what's going on over at Sephora, of course, one of the biggest competitors to Ulta. And it's TikTok. I mean, it has just gone absolutely viral. And when it comes to how Ulta sort of climbs this mountain here, I don't know how you engineer a viral campaign. It seems like a tall order.
I think, yes, it's TikTok, which you have to know how to do. And I guess it's a case of hiring executives who get it and who get how to market this way, how to market to these generations. I think also, if you look at some of the beauty retailers they've done in the UK, Space NK is fighting back. And they do quite well on membership and on expertise. And, membership cards are a way to also drive consumer loyalty. I think data is a massive one. In this result season, one of the things I found most interesting was Walmart talking about how they're using AI to predict the demand for products, where I think they said it was they could use 950 million data points created or improved using AI. And if they had done this with human, it would have taken way more people. So I think it's that kind of smart investment. But you're right, it's definitely an uphill struggle in a very competitive space.
Dasha, we thank you so much for your reporting. That is Bloomberg's Dasha Afanasieva. Very sorry. Thank you for your time. Now, coming up, Izzy Englander picks his next fund to back. We're going to have details next on what's going on in the world of hedge funds in today's Wall Street Beat. This is Bloomberg.
This is Bloomberg Open Interest. Let's take a look at stocks about 22 minutes into the U.S. trading day. You can see a rally on our hands right now, led by big tech. The S&P 500 up about 0.6%. The NASDAQ 100 up about 1% at this moment after a very volatile end to this week. It looks like we'll end in the green if this holds, but you never know. You take a look at the small caps getting in on the action, but to a lesser degree. The Russell 2000 currently up about 0.3%, Sonali.
And it's time now for the Wall Street Beat. Izzy Englander has been making a lot of news this week. His Millennium Fund is backing another external investment firm. It's been happening in a string of investments, but this time he's backing a technology-focused hedge fund, Analog Century Management, headed by Val Zlatev. Joining us now is Bloomberg hedge fund reporter Nishant Kumar, who has been reporting on this, let's say, phenomenon, because you have Millennium that has its own pods, and now you have Millennium looking to external managers. Why?
Well, that's a very, very interesting question, and that's the hottest trend in the hedge fund industry right now. It was not meant to be like this. In an ideal world, Millennium would want all these traders to come inside and trade for them. But there is a huge talent crunch going on in the industry right now. Not everyone is available to be hired. People have their own ambition to run their own firm. So this is Millennium's second best option. Everyone is doing that, but Millennium is the most aggressive hedge fund to allocate capital to external managers, roughly about a tenth of their investment teams, and there are 330 of them are external now.
That's absolutely fascinating. And this all comes against the backdrop, Nishant, of a very volatile August. And Millennium is one of the larger hedge funds also that has actually had to close some of its own pods this month after the turmoil we saw. Can you explain what we've seen this month?
Yeah, absolutely. So Millennium we have reported 3 pod closure. To be fair, I mean, they have more than 330 of them. So it's still a very tiny number of people who have been let go. And it always happens whenever there is a market chaos. Some or the other trader will get caught. He loses a little bit of money, and all these hedge funds run with really tight risk limits. Like you lose 5%, your capital is cut. If you lose 7%, you are out. So whenever traders find themselves really vulnerable in this sort of a market that we saw in August, and that's what happened across platforms, across industries, we have seen people being stopped out and fired and losing their pods.
Nishant, we're going to have you back and early next week to talk about what this all looks like. Of course, month end means month end returns as well, Katie.
Yeah, it's going to be fun to talk about that one. Bloomberg's Nishant Kumar, thank you so much. And let's get to the trading diary, what you need to be watching next week. And I'm thrilled to report that on Monday, it is Labor Day and U.S. markets are closed. Then we're back in action on Tuesday. We get ISM manufacturing data for August. On Wednesday, we get earnings from Dick's Sporting Goods and Dollar Tree. Remember what we heard from Dollar General, so things might look, I don't know, a little bit dicey there. We also get JOLTS data, and that's ahead of the big one, Friday's U.S. jobs report. All eyes on that one. You take a look at where markets are right now, though, Shonali, we are in the green. You know, we got that PCE data, at 8:30 a.m. Eastern. Pretty tepid overall, and looks like investors are taking that as a buy signal. The S&P 500 currently up about 0.6%, and it's big tech that's leading the action right now.
No news is good news on the economic front, but next week is the big week. And you know what? A lot of people still might be off given Monday.
That's true. And
they might want to come back.
God bless them.
And watch open interest.
We'll see, of course. Don't go anywhere, though. Coming up in the next hour, we'll speak to Elias Sabo. He is the CEO of Compass Diversified. Of course, the CEO of what some people call a baby Berkshire. We'll talk about all that and more coming up. This is Bloomberg. 30 minutes into the U.S. trading day. Welcome to Bloomberg Open Interest. I'm Katie Greifeld.
And I'm Sonali Basak. Matt Miller is off today, coming back next week, though. Now, coming up, marching on, stocks close in on a fourth month of gains as the latest inflation data reinforces bets that the Fed will start cutting in September. And Kamala Harris speaks in her first TV interview as Democratic nominee, saying that voters are ready to turn the page on Donald Trump. She's now leading or tied in all 7 swing states, according to Bloomberg's latest poll. And as Buffett's Berkshire tops $1 trillion in market value, we're going to speak with the CEO of a company with a similar business model, Compass Diversified. He's got a plus on middle market firms, Katie.
And let's get a check of these markets right now because we do have a rally on our hands, which is nice to see after the weird action of yesterday. Remember, we were up by quite a bit. Then we had a big drawdown in the second half of the day and ended up just about flat on the S&P 500. Different story right now. The S&P 500 sitting on gains of about 0.7%, even more so if you take a look at the big tech index, the NASDAQ 100 up about 1.2%. Of course, you think about the volatility that we saw with NVIDIA yesterday. Eventually, it did manage to drag down the NASDAQ 100, but that's your outperformer on the day. And you're finding stability in the bond market right now. The 10-year yield currently, I'm going to call it that, exactly unchanged, camped out at about 3.86%, Sonali.
It's pretty fascinating. Bringing you some breaking news now as well. University of Michigan sentiment data coming in, and the final August consumer sentiment data had risen to 67.9. Listen, that is below the estimate of 68.1, but expected inflation falls to 2.8%, which is the lowest since 2020. And as we know, that expectation of where inflation is going is very important to how consumers will behave. We are now joined by Crossmark Global Chief Market Strategist Victoria Fernandez, and let's talk about this consumer because yes, we do have really promising data here. We actually had promising data in the GDP as well, but we have that jobs data next week.
Right.
So a lot of uncertainty, and frankly, we're caught in the crosshairs. How do you handicap what's going on right now?
Yeah, consumers are absolutely the biggest concern that we have right now. I mean, they are the driver of this economy, and they are led by wages and by income. So when we look at what's happening, if you kind of look under the hood, I mean, GDP went up, it was revised, but GDI, the income component, was actually not that strong at all. And so you want to see this income continue in order to support the consumer. I just don't think we're seeing it. Next week, I know everyone's looking at Friday for the jobs report, but I actually think the JOLTS report is going to be more important than the jobs report because it's telling you the hiring rate. That is what gives you a really good feel for what's going on in the labor market. And hiring rate is down 43% for the first 7 months of this year versus the 7 months of last year. Job losses are up, quits are down, wages are stagnating. All of that will come out of the JOLTS report, and I think it gives us a good feel for what that consumer is positioned to do going forward.
At the end of the day, if you're worried about the consumer going forward, what does that mean in terms of what you expect of easing for the consumer if you see that first interest rate cut in September? That's pretty much will happen at this point. But do you need to see more than 25 to really start making a dent?
25 really isn't going to make that big of a difference, I think, to most people. I don't think you're going to go out and buy a car because 25 basis points less.
Or a house.
Right? Or a house. Yeah. I just don't think that's going to be your driving factor there. So, you know, just like we have lags when rates are moving higher, there's going to be a lag as rates move lower too. And I think it's that period between still having the lags from higher rates filter through this economy, waiting for the effects of lower rates to happen, that really is going to give us the volatility and the concerns we have in this market. Yes, I think 25 basis points is what we see from the FOMC meeting in September. I actually think we only get one more this year, probably in December, and the market may have to reprice a little bit because right now they're saying 100 basis points.
Yeah, I was going to say, I mean, if we only get 2 and we have 4 priced in, it feels like, I don't know, some of the investors out there on the street are a little bit giddy because they fought the Fed and they kind of won. When you think about sort of the resolve to hold rates steady, now you have the Fed and Jerome Powell all but saying we are going to cut in September and then keep cutting. What would the adjustment from pricing in 4 cuts to 2 cuts look like when you think about the S&P 500, the big tech names?
Yeah, Yeah, so we're looking at an S&P right now after the pullback and then such a quick, kind of whipsaw back to where we were. You're looking at an S&P that's tactically in an overbought position. We're going into a very weak season for the month of September historically, and the market usually does not do so great 3 months following the first rate cut. So it's actually a very tough environment we're going into here for the rest of the year. I think you get that 25 basis points, then I think the Fed wants to wait. They want to take their time, see what happens, see some of the data that comes in, maybe take a break around the election time period, and then come back and continue cutting at the end of the year. They don't want to go too quickly and stoke demand and stoke inflation, but at the same time, they want to support the consumer. So it's a very thin line that they have to walk there.
So how should investors be putting this all together? Because even with the volatility that we've seen this summer, I mean, we're sitting on pretty healthy year-to-date gains. We're entering into what we know is going to be a pretty volatile season. And I mean, do you just be happy with what you have? Do you just sort of sit tight through year ends?
Well, you definitely don't want to stand in way of the momentum of the market, and you want to participate in that upside. But I don't think that means that you have to be completely risk on. I think it gives you the ability to be a little bit cautious in your approach. So look at some of those larger cap staples. Staples usually do better after a first rate cut. Look at some healthcare names, same situation there. We've been trimming tech and adding to some of the financials for the course of this year. So there's elements you can do, some tactical shifts you can do in your portfolio to put a little more defensive play to go along with the volatility that we expect, and perhaps a pull down if the consumer does slow down more, but yet you're still participating in this market. So I think that's how you need to position.
You know, the people that we speak to on the show all week have been calling this a broadening trade. It was a rotation trade, now it's the broadening trade. What do you broaden into, especially because in this broadening trade, there have been some notable sectors left out, some places tied to the consumer, and even energy, which is a little strange considering what you've seen with energy prices this week.
So a lot of the broadening that we've seen has been tied to the small caps, right? We've seen the Russell 2000 really do well. You look at the end of last week, Russell 2000 had a plus 27 to 1. So really strong breadth. Based on our outlook, we're not so sure that that's where you want to go right now. If you have a little bit of exposure, that's fine, but we would be cautious with small caps. Maybe wait till some of this plays out, some of the volatility we expect play out. Go back to some of those more defensive plays that we like. I think you can broaden out that way and then wait for earnings to broaden out. That's going to be key for next year.
I'm surprised you didn't pick up on financials. That's like your backstop.
I have been holding myself back from this. We can talk more about that in a minute.
It's been a great place to be invested this year.
Stocks or small stocks. Here, at the end of the day, it's really those investment banks, JP Morgan, Goldman Sachs, that have felt that love. Not so much many of those regionals.
In this type of environment, you want to look at those companies that have strong cash flows, consistent earnings, the ability to withstand volatility. Those are the larger banks. You have to be cautious on the smaller banks because I know we haven't seen the real estate issues come to fruition like many thought they would, but those small regional banks still do have a lot of exposure. We like those larger banks, and they've been doing well.
Well, at least on the larger banks, it seems like Wells Fargo's Mike Mayo agrees with you. He was out with a note earlier saying that bank stocks to rally with rate cuts and no recession, which is all great, but sort of a concept that we've been batting around for the past couple of weeks is it feels like the broadening is nice to have, but what a need to have is, when you think about the broad index level, is that tech performance, that tech participation, just if you do the math on the index level. And with that being said, I mean, what is the outlook for tech?
Well, they've definitely been driving the market for the past year and a half, 2 years. We've seen them pull back this year, and that's where everyone's saying we need to see others step up. So does tech continue to grow? Does it continue to do well? Yes, and you look at these names. Look, we have long-term investors that we're working with. Do they want to have Microsoft and Apple, these names in their portfolio? Absolutely they do. Do you want to have exposure to NVIDIA? Yes. But can you be a little bit underweight? Can you take some of your gains that you've gotten so far this year, trim that down, take those funds and then put them in some of these other areas we've been talking about? Yes. So you want tech to do well. There's such a large percentage of the index, right? I mean, NVIDIA itself is 6% of the index. I think that's almost the entire weight of the staples. So you have to have some exposure, but I think if you believe other areas areas are going to do better, you can underweight that sector and start allocating to some other places.
You know, the other thing that you were saying about the large financials, something that's been amusing me in this market, Katie, is that you have banks making money on M&A. You have them also making a lot of money on turnaround stories. That is spinoffs, that is activist investors, that is bankruptcies and restructurings. This is a costly market for a corporation, right? You see Intel just soaring this morning off of Bloomberg's report that they are talking to their bankers. When you look at these turnaround stories, even certain analysts seeking bigger turnarounds at places like Ulta, do you buy into a turnaround story? Is that where some of the biggest opportunity could be at the single stock level?
It could be, Sonali. I mean, I think there are those opportunities out there. There are those single stock elements that you can look at. But I also think you want to take a broader approach, right? Look at it from a macro perspective and say, are these just small one-offs that are happening? Or are we walking into an environment where the economy is going to pull back enough where we're going to need to see some consolidation, some mergers, some buyouts? It could absolutely happen that way, and banks will be a beneficiary of that for sure.
And before we let you go, just quickly, I'm curious. I mean, you talk about not being too, idiosyncratic, but it feels like it's really hard to look at an industry and paint with a broad brushstroke here. I mean, you think about what we saw from Dollar General, I believe, the state of that low-income consumer, and then you think about Walmart taking share from a dollar store such as that one. I mean, it just feels like there's so many nuances when you look at these earnings reports.
It's a very bifurcated market, and it's across the board, right? Retail earnings completely confused me with some of the things that we were seeing. Walmart pulling share, but not necessarily for the lower and middle income, but they're pulling share on the higher income consumer as well. So it makes sense that they were doing better. But you see a lot of other stores that typically do well in Ulta and a Lululemon missing estimates, not doing well, showing you that the consumer is, pulling back and doing that. That bifurcation is across the board in different industries. So you do have to be selective. You can't just buy all of one sector, and you got to do your homework. Look at those earnings, look at those cash flows and balance sheets.
All right, that's a good place to leave it. Do your homework.
That's right.
Victoria, it's always great to see you. Great to see you in person, too. That, of
My
course,
pleasure.
is Crossmark Global Chief Market Strategist Victoria Fernandez. Meanwhile, let's take a look at some of these movers because it's still earnings season. Somehow you take a look at Lululemon, for example. You can see shares kind of wavering back and forth. They were lower. Now they're a little bit higher. Of course, up 1%, even though they warned about that sales forecast. Ulta Beauty, different story there. Of course, down about 2% on disappointing earnings. Had been down more, though, about 7% pre-market. So some of those losses coming back. And then Intel, we know the story there. Of course, Bloomberg News reporting that they're talking to bankers about potential options here. A very tough time for a 56-year-old company. Shareholders seem to be embracing that right now. Intel up about 7.5%. Now coming up, VP Kamala Harris, her comments on inflation, the border, energy, and more in her first major interview since running for president. Details next. This is Bloomberg.
And now to high interest, a look at what's making headlines around the world. And if you're an investor pursuing a 60-40 strategy, you might want to keep the ratio but drop some of the bonds. Strategists at Bank of America are urging portfolio managers to swap commodities in for fixed income, as the asset class tends to perform better in a period of prolonged high inflation. And MasterCard is doubling down on efforts to eliminate use of credit card numbers when customers make purchases online. And the move is the latest by the company to try and fight fraud in e-commerce. And there's about 2 months until the U.S. general election. Vice President Kamala Harris joined Tim Walz in an interview on CNN. And here's how she described her economic agenda last night.
It's what we need to do to bring down the price of groceries. For example, dealing with an issue like price gouging. What we need to do to extend the child tax credit to help young families be able to take care of their children in their most formative years. What we need to do to bring down the cost of housing.
And for more on Harris, we're joined now by Bloomberg's senior White House and politics correspondent, Gregory Korte, joining us from Washington. And so I liked what you said in the commercial break, that basically Kamala Harris needed to rip the Band-Aid off here. We had been waiting for her first interview, of course, not sort of a teleprompter read, but somewhere where she'd actually have to interact and engage with questions from the press. What has the reception been like so far?
Yeah, she's been in this race now a little more than a month. This is the first sit-down interview she's done through all of that. And so, as you said, there was something she needed to do. She needed to tick off the box. And look, if you were looking for her to put a lot more meat on the bone in terms of policy, in terms of what a Harris administration will do, especially how it would differentiate itself from a Biden administration, you were probably disappointed. But she can say that she did it. She probably didn't do herself a whole lot of damage. And I think it gave her a little bit more exposure to a national audience of who she is and kind of get a sense of how she sees this campaign, what value she's going to bring to it. So in that sense, no, I don't think she did herself any harm, but it also wasn't, she probably didn't win a whole lot of new votes either.
Right. Well, let's sit on that point a little bit longer, that she didn't do any harm. Was that really the goal for this appearance? You think about all the momentum she's had in the past month, of course, and you've seen that in the polls as well. It seems like, of course, not doing harm here maybe was the right tack to take.
Look, modern political campaigns are extremely risk averse, and it's pretty rare to see a candidate go into an interview with a hostile or even a neutral interview. Both candidates, you see this especially on the Trump side, really going to Fox News, some conservative media to have his message. It's not very often that he sits down with a more mainstream outlet. And we've even seen this with the debates. We are going to have a debate, we think, on September 10th, but the whole debate regime has broken down as candidates. We saw with Joe Biden, it is a very high stakes endeavor. The debate in June can make or break a campaign, and it broke Joe Biden's campaign. So, yeah, both campaigns are going to be really cautious going into the final couple of months, not to do anything that might get them into a situation where they might make a gaffe or a big mistake that the opponent can seize on.
Gregory, at the end of the day, when you look at the way the interview went last night, risk averse is the word a lot of people are using. How does that pair with what you're seeing in the polls? Was so much of this risk aversion meant to keep a little bit of status quo in her standings?
Yeah, so what we've seen, and we have a new Bloomberg News Morning Consult poll just out last night that shows that she's continuing to build on the momentum ever since she was took the reins of the nomination from Joe Biden. Harris is now up by 2 percentage points across the 7 swing states that we look at. That's among registered voters. Among likely voters, it's 1 percentage point. We're going to start talking a lot more about likely voters after Labor Day. And so did she get a post-convention bounce that we all look for traditionally after accepting the nomination in Chicago last week? No, probably not. There's maybe a 1 point increase since last month. That's well within the margin of error. But she continues to have this momentum, and she's now tied or leading Trump in all 7 swing states. It's still on a razor's edge, this race. It could go either way, but you would rather be in Harris's shoes than Trump's, and that's what making her a little bit more cautious and a little bit more defensive. It's now incumbent on Trump to sort of seize back the narrative, seize back the advantage.
Yeah, like you said, of course, a dead heat when it comes to this Bloomberg Morning Consult poll, when it comes to these very crucial swing states. But when it comes to Harris's polling here, how does the economy factor in? You think about some of the top issues in this election, and increasingly it just looks like it's really this focus on the economy.
Yeah, and as you know, the economy is the top issue in this election and every election. And when we look underneath what's going on these top line horse race numbers, we're trying to figure out what's driving that. And interestingly, voters' perceptions of the economy have not changed since Joe Biden was the Democratic candidate. People still say prices are too high and going higher. A majority of swing state voters still say they were better off under Trump than they are under Biden. But the thing is, they're not holding that against Kamala Harris. If you look at a whole bunch of different measures of candidate trust, we asked on a bunch of economic issues, do you trust Harris or Trump more? She has now taken the high ground on issues like housing costs, pay raises, personal debt, things like student loans and credit card debt, and she's closed the gap on a number of other issues. Importantly, inflation. She has improved her numbers considerably. She still trails Trump on the inflation trust question, but she has narrowed that gap considerably. And so when people look at Kamala Harris, they are not associating her with the Bidenomics that wasn't going over well with the Biden campaign before he dropped out.
Gregory Cordy in Washington, we thank you so much for the latest polling and, of course, the readout from last night's Harris and Walz interview. And for the latest on the U.S. election, head to ELEC, ELEC, go on your Bloomberg terminals. Of course, all the latest on what's happening ahead of November. But still ahead, we're going to talk about Starbucks, where more trouble is brewing. We're going to talk about a new lawsuit that alleges the company deceived investors. That's in Social Climbers next. This is Bloomberg.
On September 10th, as Election Day approaches, Vice President Harris and former President Trump hit the stage for the first time.
Oh, we're going to beat her. I look forward to the debate.
If you got something to say,
We'll bring you informative analysis.
Will that debate decide the outcome of this election?
It's going to come down to both policy and performance.
Tune in to Bloomberg Television for the ABC News presidential debate simulcast with special coverage starting at 8 p.m. Eastern. Context changes everything.
now for Social Climbers, the company's making waves this morning. And first up, Starbucks getting hit with a class action lawsuit that accuses it of misleading investors about its financial health and growth prospects. The lawsuit alleges that Starbucks provided overly optimistic revenue projections while hiding significant challenges, especially in the Chinese market. Starbucks says that the allegations are without merit. Next up, Alibaba is securing the endorsement of China's antitrust watchdog after 3 years of a probe into its online behavior. The move suggests that Beijing is keen to signal its support for the country's giant internet sector. And finally, Emergent BioSolutions announcing that the FDA granted approval for its smallpox vaccine for use in people at high risk of Mpox. It's the second approved shot against Mpox in the U.S., and it comes as a new Mpox strain is spreading in Africa. And of course, you can follow all the latest company buzz on TREN Go on your Bloomberg terminal, Sonali.
I'm going to check on these markets, Katie, because of course we are ending this August on an up day at least. Of course, it's been a tougher week for the S&P 500, about to end in the red for the week, but up on the day, 0.4%, calm in the markets before a long holiday weekend. NASDAQ 100 up almost 0.8%, and the bond market steady after that PCE and University of Michigan sentiment data. Of course, the big week is next week with that jobs data, isn't it?
Big week next week. And of course, September, a seasonally ugly month. So we'll see how that one shakes out. But
buckle up.
Coming up on this program, the investment holding company Compass Diversified. We'll speak with the CEO next. This is Bloomberg.
Bloomberg.
Warren Buffett's Berkshire Hathaway becoming the 8th U.S. company to top $1 trillion in market value. We're going to turn to a public company with a similar investment profile, Compass Diversified. It acquires controlling interests in middle market consumer names, giving shareholders access. For more, we're joined by Elias Sabo, Compass Diversified CEO. And of course, this kind of model of buying into a range of companies here has become a really hot topic on Wall Street, Elias. But everyone knows who watches Berkshire Hathaway. So much of the magic really comes from not only that focus on value, but the cost of funding that is required to make those investments. We're on the precipice of a historic interest rate cut. How much will that make a difference to your business?
Yeah, Sonali, it's, huge in our business. And if you think about what Berkshire has done, very similar to what we're trying to do is create a sustained cost of capital advantage relative to our peers. Berkshire has done it magically with, kind of an insurance holding company that has helped to, fund their business. We do it through having a holding company that does the financing rather than at the subsidiaries and getting the arbitrage of financing with scale. And so in both models, cost of capital is imperative. As that cost comes down, clearly we and our competitive set and peers are going to benefit from that. But in absolute valuation of the assets, it is a positive to have rates come down, and, it's positive for the valuation of our portfolio.
It's kind of fascinating to talk to you at a time here where you see a market that for a moment got addicted to small and mid caps and then pulled back on that bet, worried about the leverage in that system and worried about growth moving forward in the economy. At the end of the day, this is a market that you're highly levered to, the middle market. What comes from here? You do see that potential reduction in interest rates, potentially at a significant pace, but you still have those growth concerns. How do you get past them?
Yeah, so between the first and second quarter, we saw a market downturn in activity. And, that can be anything from sales that we're realizing, kind of in the quarter to bookings that we're getting for some of our companies with a longer lead time. And so far in the third quarter, we've seen that steady out a little bit. So, sort of like the car went from third gear to second gear and has sort of stayed there. On the other side, on the cost side, we've been seeing inflation come down now for the better part of the last 12 months. And, labor pressures have really eased. Some of the macro data has been supporting that recently. And frankly, it feels a lot like pre-pandemic where customers are asking for price declines. We're trying to get that from our vendors as well. So it feels like inflation is dead. To me, that feels like a pretty good, environment where the soft landing narrative feels like it's in play right now. Yes, growth is slowing, but our cost of capital is coming down even faster. It feels like, growth could pick up 6 to 9 months based on how quickly the Fed acts. And, it feels like the Fed is inclined to be cutting. My view is they need to cut a little faster than probably what the market is pricing in right now, just because conditions do feel like they're softening. But more importantly, inflation concerns seem like they are, near dead at this point.
Well, let's bring this conversation, of course, to deployment opportunities, because if we continue on with the Berkshire metaphor here, of course, your company is thought of as one of the baby Berkshires that are out there. I mean, you think about what Warren Buffett is doing. He's sitting on approximately a mountain of cash. I think it's safe to say, rather, because he just doesn't see the opportunity out there. You look at, of course, your history. You've completed 58 acquisitions since you IPO'd in 2006. What's your opportunity set right now?
Yeah, Katie, it's been a really weak M&A market over the last couple of years. Sellers have been very apprehensive to come to market as a result of, kind of the tightening interest rate policy and valuations, which clearly are going to be depressed in that environment. Our model is to look at very innovative and disruptive businesses, the type of companies that we want to own. They need to be able to demonstrate that they can outgrow their core markets by 2, 3, 4, 5 times, of growth rate. So a 4 or 5% growing market, we need to see 10 to 15%, growth capability and that kind of share gains that come along with it. Unfortunately, those type of businesses have not been trading given some of the valuation concerns. So for us, it's a little bit different as M&A activity picks up. When we find companies that fit those characteristics, that is what we go, really aggressive on. And it almost is irrelevant as to the macro. And the reason is because these companies can take such share that we're able to, kind of fight through macro headwinds. And then when tailwinds emerge, it's really a great companies to own. So, we're a little agnostic to the macro if we find the right opportunities, but the market has been really moribund over the last couple of years.
So slim pickings, to put it mildly. And on the other end, I'm curious what that process looks like. How often do you exit a holding?
Yeah, so our average is about 7.5 years mathematically. We really differentiate from the traditional private equity structure who competes for these type of assets by holding these companies for a much longer hold period. We are experiencing the same thing, Katie. We did transact on a company, Marucci, during the middle of in 2023. Early on, that was a great asset that we owned. I'm sorry, it was at the end of 23. And so there are selective opportunities to be able to divest businesses, but broadly, we're also seeing the weakening M&A market because of interest rates. And without pressure to have to sell any of our assets, we've been more in a pause mode. I think as rates come down, it's going to present a much better opportunity for these markets to unthaw.
Elias, I want to just put a pin in something that you had just said about the private equity market, though, because it is a competition that you're facing that is worth addressing. There's record amounts of dry powder and the middle market becoming even more attractive. How does that complicate your hunt for deals?
Yeah, so no, it's, it creates more demand for these assets. And so the time that we're coming in, and I said, yeah, it's really favorable because interest rate declines are going to be great for our earnings. It's going to be great for the value of the assets that we own. But our peers are also going to benefit in the private equity market from more access to debt capital, reduced cost of that capital, and they're sitting on record piles of capital. So I would fully anticipate that the new acquisition market becomes frothy again with this backdrop, provided that growth concerns don't, turn into a recession, and that the competition for assets is going to really pick up and prices are going to be significantly higher than what we've seen over the last few years.
And I'm sad to say we only have about a minute left, but I do want to talk about structures here for a second. Again, coming back to that Berkshire Hathaway example, of course, Bill Ackman had withdrawn his IPO for a closed-end fund. The FT is reporting, of course, that he might revive that. But ahead of that withdrawal, he has touted it as basically Berkshire being a model for the closed-end fund, trying to do a similar thing. So you think about, of course, a closed-end fund structure, and then you think about the structure that you have as a holding company. What do you see as the advantages of what you do versus, say, a closed-end fund?
Yeah, so it's really in the types of companies that we're buying, Katie. We're buying these smaller middle market companies, controlling interest, and our model is to own them and to help them to become better companies. And that could be through management additions. It can be through systems, processes. So we consider ourselves more strategically active owners. If you think about a Berkshire Hathaway or a Pershing Square, they are more dabbling in public stocks where they're going to be less influential in the day-to-day activities of those companies. So, they're much larger companies that they're buying. They're really like portfolio managers in a lot of cases. Our model is much more active, hands-on, smaller companies that, the normal public investor would not be able to gain access to because these are $20, $30, $40 million EBITDA companies when we buy them. And our goal is to turn them into $100 million plus EBITDA companies. But they're just too small for the typical investor to gain access to unless they are coming through us, where these other structures are essentially public companies that are being purchased.
All right, sadly, we have to leave it there. fascinating conversation. Hope to have you back again soon. Our thanks, of course, to Elias Sabo of Compass Diversified. Meanwhile, I take a quick look at these markets right now. The S&P 500 hanging on to and building upon those gains, up 0.6%. The NASDAQ 100 about 1% higher right now, and all quiet in the bond market. 10-year yields pretty much unchanged. Now, coming up, one of the most memorable conversations this year from Wall Street Week. Centerview co-founder Blair Efron on private equity's comeback next. This is Bloomberg. As summer draws to a close, Wall Street Week is looking back at the first half of 2024 and forward to what the rest of the year holds for investors. In January, David Weston sat down with Centerview co-founder Blair Efron. Here's what he had to say about deal making, talent management, and the growth of AI.
I think private equity will be a very strong driver in 2024. If you think about the years preceding 2023, it's basically 40% of the market. There is such a large group of companies that are looking for liquidity, and coming from private equity, that I do think it'll be a very active time. And again, that goes directly to the financing markets as well. The financing arena will be more liquid than it was last year, and we're seeing most of the private equity world think about being more active. And frankly, to their credit, They slowed down activity at a moment when they should. Last year it was much easier for a corporate to look at something and not think they had private equity competition. This year, when we see companies we're selling, the interest is both corporate, we're already saying it, corporate and private equity.
How much of your business in merger and acquisition is driven by essentially the need to reform parts of a sector? I mean, I'm thinking of one that I come out of media right now. There's a lot of pressure right now for some of the big media companies to really think about the cards they've got and how they deal with them and how they get rid of some, how they pick some up. How much of M&A is really driven by these big companies saying, we got to really restructure?
Today, I think it's most of it. Transformation is happening so quickly and is so disruptive that every company is saying, here's my portfolio today, but where's it going to be tomorrow? So even when you talk about your world, media, it used to be traditional media with 3 networks. Now it's traditional and non-traditional players. Apple, Google, Amazon are as active as Disney, Comcast, Paramount. Gaming, what is technology, it all becomes one industry. If I go across any industry, that is what we see. I look at the pharma world. The fact is, life sciences is one of the biggest areas out there. Why? Because we have such innovation going on in this country. So many companies you never heard of 5 years ago and never heard of that have become really important just 5 years later, that this becomes a window when you think about R&D for a big pharma company. It's more interesting in many ways to buy than build. So I would say that every business is being challenged in ways it never was before, and it's causing CEOs, it's causing boards, causing seasoned leaders to constantly rethink their ideal portfolio, recognizing there is never an end state portfolio anymore. It is always going to be evolving. And the good news is we have as talented and experienced a group of leaders as ever. So when a CEO undertakes M&A today, chances are strong that he or she is going to end up doing a good job and the right thing for the company, both strategically and financially.
All of which supports your view that 2024 looks like it'll be a lot stronger than 2023 in mergers and acquisitions. What does that say for Centerview Partners? Are you hiring? And if you are hiring, what sorts of people you're hiring? Because it looks very different than it did certainly 10 years ago, maybe 5 years ago, because of some innovation. Not to speak of, for example, generative AI.
Boy, that's a great question. First of all, we are hiring, so anybody has a resume, let us know. We're always hiring. The skill set we look for is probably different than you would think. We want people who can think critically, who can analyze situations, who have judgment, have an ability to make difficult problems distilled into more simple problems, and it's less about whether you can make a great model. I do think when AI over time will replace some of the skill sets that we see traditionally done in STEM, coding, for example. I'm not sure that if I was, I'd be advising my kids that learning how to be great coders is going to matter in 10 years. What will matter is, do you have judgment? Do you have an ability to think critically, as I mentioned? And ask questions that need to be asked, that you can see situations of what am I missing? And I think that is a skill set that people are going to find is increasingly important. And you also have the skill set that says, I'm going to have 3 careers. What do I need to know to have 3 careers over my professional span?
And that was Centerview Partners co-founder Blair Efron speaking with David Weston back in January. And he's an interesting man, Shonali.
He is a very interesting man. It's fascinating. This part of the year, yes, it's months left to go, but you have Centerview actually beating out Bank of America in terms of M&A league tables right now. Blair Efron is known to be an advisor to large corporations, but his commentary here on private equity really coming back is critical to this M&A revival. There's something else about him, too, that I think we need to notice, and that's his closeness to the presidential election, the Kamala Harris campaign. There's a lot of rumors about how he could potentially be a critical person, potentially in her cabinet moving forward. Commerce has been thrown around. We've written about it already. But in addition to that, he actually was a large supporter of her in her prior presidential run, in addition to her current one. So longtime supporter.
So definitely someone to keep an eye on, of course, as we count down to that presidential election. That, of course, was Blair Efron. And tune in for a special edition of Wall Street Week tonight at 6 p.m. New York time. This is Bloomberg. So the late Jack Bogle, father of the first index fund, famously loathed ETFs, warning that they only incentivize speculative trading among, quote, fruitcakes, nutcases, and lunatic fringe. Fast forward to 2024, and critics warned that a new generation of ETFs are being designed to do exactly that. Enter the high-octane world of single-stock ETFs, which use derivatives to lever up daily returns on a single company. Joining us to discuss this quickly growing category is Bloomberg Intelligence analyst James Seyffert. And James, just set the scene for us, because to a lot of people who don't live and breathe ETFs, a single-stock exchange-traded fund sounds like an oxymoron.
I mean, it kind of is an oxymoron. I mean, the benefit here is it really is just taking, there's a lot of things in the ETF world, they're prepackaged trades. They're doing things for you that you otherwise probably could do if you took the time to do it. So in this case, sometimes it's an inverse, a single stock, inverse NVIDIA, what you name it. Or sometimes it's slightly levered. So we just had the 1.75x micro strategy. So you're adding leverage. Sometimes it's inverse, sometimes it's long. It's just basically a prepackaged leverage trade on an individual stock. There's not much more to it other than that. It's just an easy way, and honestly, a lot of people like it because it's a capital efficient way of doing a trade rather than actually borrowing on margin and different things like that.
Yeah, exactly. Cheaper than opening a margin account or getting access the traditional way. But of course, that attracts critics who say that retail investors shouldn't have access to institutional grade margins. So talk us through sort of the debate here, because people say these are designed for day trading, and it seems like the data actually backs that up.
Yeah, that's right. These things, one of the critics is like these things aren't being used properly. Any sort of trading data that you look at, you can kind of guess how much, like what percentage of the holdings of the fund, not holdings of the fund, but the holders of the fund are turning over. And in many cases, these funds are heavily traded. They're probably being used properly by the vast majority of people using them. So there's some of these, the actual shares of the fund turn over every 2 days, 100% turnover. So that means these things are being traded heavily like they're intended to. The problem is how many people are in that group that are not using them properly, don't understand what they're getting themselves into. And I can see the argument being made that, yes, maybe there should be some sort of prerequisite before you're able to touch these, just like there is a prerequisite to get a margin account. That said, I'm all for the big tent. Allow people to use what they want to use in the ETF market. There's plenty of things out here for long-term buy and hold, and there's plenty of options out here for short-term tactical trading.
James, that's a lot of turnover. So at the end of the day, what happens if you hold it for too long, and how long is too long?
Yeah, I mean, realistically, you shouldn't be holding these things longer than like a day or two, maybe a couple of days if you know what you're doing. That's what they're built to do. They're going to generate the return, those leverage returns I was talking about earlier, on a daily basis. And then it resets the next day. So basically what happens, there's something called volatility decay or leverage decay. And over the long term, if you have a 2x NVIDIA ETF, it's not going to generate the same return as a 2x NVIDIA over like a week. It's just one day and then it resets every day. And oftentimes you get nowhere near what you would expect 2x NVIDIA to provide. So really, as long as you know what you're doing, you can hold these a little bit longer and understand the position that you have. The problem becomes when there isn't enough education and people don't understand, and you're holding these things for weeks or months, and it's been extremely volatile, and the stock in theory could be up over that time period, and a 2x long ETF could be down just because of the volatility I was talking about.
It's kind of like the movie 50 First Dates, where every day is a brand new day, everything just resets. And in the minute we have left with you, I do want to talk, though, about this sort of cultural shift that's underway in the ETF industry. Because, again, to people who don't live and breathe ETFs mean passive index tracking vehicles. And at the same time, you have these incredibly, very highly active ETFs that continue to launch and are extremely built for the speculative trader here.
Yeah, honestly, I think the two biggest things I've seen over the last year or two is two ends of the spectrum, right? We have these complex derivative-based products, but what they're doing is we call these buffer ETFs or structured outcome. They're exact opposite of what we're talking about here, right? They're basically Xanax for boomers. They're taking the edge off. Whereas these things on the other end that we're talking about here, these single stock leverage ETFs, these really complex products, are the exact opposite. They're almost like amphetamine. So like we're basically broadening out the tails here of what ETFs are able to offer end clients.
James, we thank you so much. We're out of time. Hey, Katie, do these go short too?
Yes, they do. They go short and then they go short again. And it's a good way to burn yourself if you're not paying attention.
Rip your face off trades.
Yeah, exactly. And of course, you can catch ETF IQ. Usually it's on Mondays. It's on Wednesday next week because of that Labor Day holiday. That's at noon Eastern. Of course, that does it for Shonali and I for the week. And that does it for, the month of August. It was quite a weird one, quite a volatile one. We'll see what September brings. But much more coverage coming up on Bloomberg TV. This is Bloomberg.
Changes everything. From the heart of where innovation, money, and power collide in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
Live from New York and San Francisco, this is Bloomberg Technology. Coming up, Intel's working on a plan B. The Bloomberg exclusive on bankers eyeing a potential sale of the foundry division and more cost cuts.
And Elon Musk's battle with Brazil deepens, threatening social platform X and SpaceX's Starlink business. We have the details.
And tech fights to end the week strong as Nvidia claws back and Dell's earnings add to some AI belief. We have a key CIO on the show. But first, let's just dwell on these markets for a moment. We end the month as we started it. on the downside. We had a brutal sell-off to start August, and today we are down 1.5% if you look at the last 5 trading days. We're trying to make some power higher on this Friday, and we have certain names to thank for that. But more broadly, this has been a week we were fixated on one name and one name alone. It was NVIDIA, and it just didn't live up to some of the hype. But Ed, what are you watching on the micro data today?
Yeah, you can never quite guess the news flow. Intel is up at this point the most since October of 2023. At one point in the session, the most since October or late 2022. And there is a detailed note from Bloomberg about basically the plan B, as you put it. Caroline, what are the details of that reporting? Because clearly the street likes it.
It's Bloomberg exclusive reporting, in fact, learning that Intel is looking to its investment bankers for help navigating the most difficult period in its 56-year history. Now, the chip maker is said to be discussing a range of scenarios, including a split of its product design and manufacturing businesses. I'm pleased to say Bloomberg's Ian King is the man helping drive that exclusive reporting. And maybe this should come as no surprise, but it is quite a wholesale look at the business.
After their earnings announcement, there's clearly been a lot of pressure on the company, and clearly people are looking at this company and saying, can it do what it's set out to do? So it's kind of natural, really, that the management and the board would do their job, and that's how look at their options, really. What we understand, though, is that nothing has been decided, and everything is really in the sort of preliminary stages. But I think, you know, as the market is showing us today, this is kind of a healthy and a natural thing for a company in this kind of a situation to be doing.
Well, we called it Plan B, but it might as well be Plan C, D, E. You know, things have been difficult for Intel. We use the word chip maker a lot for all kinds of semiconductor companies, but in Intel's case, it's actually true. You split the business in 2 parts. They design chips and what they do, and then they manufacture them for themselves. The problem they've got is that they don't currently manufacture chips really for anyone else, and that's the financial issue.
Yeah, it's a conundrum, right? They're saying, look, we want to be a foundry, right? We want to do what TSMC does. In order to do that, we need more factories, we need more technology, but that costs a lot of money. The money comes from the products that they sell. The amount of products that they're selling is sort of going down or not being as lucrative as it used to be, so it's a difficult situation. So the argument has been for some time now that perhaps these 2 divisions are better off separate, and that way it's going to be easier to attract outside customers.
The key issue is that Pat Gelsinger came on, and this was kind of his focus. I just want to go back to what he was telling the market, the investor base, a few months ago. Just take a listen, Ian.
We delivered a solid Q1, right? We met on revenue. We, beat on earnings. A bit tepid in the first half, as we said, but we see a lot of, improvement as we go through the year. And with that, obviously, the foundry business, as I would say, we're going to see progress on the foundry business every quarter from now to the end of the decade.
Maybe not to the end of the decade. How much of an impact is this on Pat Gelsinger in and of himself, Ian?
Yeah, I mean, he came in, he was brought in to turn this company around, if you like, to make up for the mistakes of his predecessors. The problem is that it takes time, right? You don't design a chip one day and have it on the market the next. We're looking at years to sort of have new products out there and gain traction. So in a sense, he's doing what he said he was going to do, and at the time investors signed off on that. The problem is we're looking for the bottom. We're looking for the point at which things start to get better, and I think the problem that Pat has is a lot of things have come together, and that hasn't happened yet. We don't have a sign that we're back on the upslope.
Bloomberg's Ian King, thank you for this entire week, NVIDIA earnings, the reporting. It's been quite a week in the world of semiconductors. It's been a big week in markets, particularly for technology investors. Understatement. The focus, NVIDIA's earnings, that just weren't enough against sky-high expectations, but economic data, central bank speak, tech earnings at large are all on your desks too. Joining us now is Lei Chu, Chief Investment Officer of Thematic Innovation Equities at AllianceBernstein, and that's where we start. Do we know more about the world of technology, particularly the longevity of this AI investment cycle, than we did prior to NVIDIA's earnings print just a few days ago?
Well,
Thank you for having me here. So to start, one, demand remains very strong, and we're at the very early stages. When we say demand is strong, so we're seeing it across hyperscaler, we're seeing it from enterprises, and we're seeing it from nations as well. So at this stage, and then with new product coming, you continue to see very robust demand for existing product. That's something actually we've never seen before in previous product cycles. So that's a strong signal. And then two, when we say early stages, is yes, it's early stages, particularly on the supply side. We're going from manufacturing a single chip to system level compute. So a lot of things have to come together, whether it be memory, networking, software, and even on the infrastructure side, the power, the cooling. So a lot of it has to come together, and the ecosystem itself on the manufacturing side has to adapt. So there will be unevenness from time to time. So go back to there's a demand-supply imbalance, but we remain very constructive on the outlook of AI.
Lei, AllianceBernstein, based on Bloomberg's data at least, is the 22nd largest shareholder of NVIDIA. Just generally your reaction to the earnings statement call and basically the whole watch party that was happening for that name around the world?
We believe that NVIDIA remain one of the leading players in the AI ecosystem. What they're doing is transformative, and it is early. So when you look at innovation and this early in the product cycle, you will see quarter to quarter perhaps a little bit unevenness. But as we believe, sometimes you have to look out to even make money near term or long term. So we continue to have a constructive view on the AI ecosystem as a whole, and we believe in NVIDIA's leading position as well.
Lei, I can only imagine how often at a cocktail party or dinner party you are taken to one side and grilled over really what the return on AI investment really is. Everyone's trying to understand when generative AI is really going to change all our lives. What do you say to that?
First, I would say, one, it's about accelerated compute. It's a new form of compute that's far more efficient and powerful. And when you look at the existing players, the hyperscalers, they're using it to support their current business model. So if you look at infrastructure as a service in the cloud, you're seeing they're spending because Azure is growing, AWS is growing, GCP is growing. So that's one use case. And then two, in some of the existing industries, whether it be advertising or life science or autonomous driving for that matter, you are starting to see generative AI actually make a positive impact already. And we actually believe this is a great time for active investing because this is a time we can use it to identify the future winners and leaders, because it is an opportunity when such a transformative product cycle happens, you redefine who are the future winners and leaders. It's a once in a lifetime opportunity for these players to actually get into each other's backyard. So we actually think you're going to see more and more business model emerging. We always say sometimes you take a step back. Without the build out of the mobile ecosystem, we wouldn't have had Uber, Spotify, Facebook for that matter. So we wouldn't have had the suburbs if we didn't build a highway. Right. It's still early, and we believe the infrastructure build out itself is already supporting some of the existing business models, and we're watching very closely across industries to see new business models actually emerging.
But what's so interesting, you've been doing this since 1999, 2000. Many people go back to Cisco in those years and ultimately how far it ran up, and this focus on one particular name, but indeed the entire tech sector. Is there just too much focus on a singular name like NVIDIA? When do we start to broaden out? When do we not get the ultimate crash that we saw back in the 99, 2000s run up?
Yes, I agree. The market is hyper-focused on one name, but we are focused on the entire ecosystem. In fact, we think there are a lot of opportunities outside. If take a supply chain, for example. If we take a step back and then think at high level, there's such supply-demand imbalance. The demand remains so robust, and we are having supply chain issues. So one can say that when there is such imbalance between demand and supply, there's pricing power, there's new profit pools. And then also, with AI, we're really redefining the future business models. So you can actually find future winners and losers. So it is not just on one stock, it's rather the accelerated compute, the impact on the future of technology, and frankly, the future of economic growth.
Lei, I tried to speak to Jensen Huang about the energy component of the supply chain. Let's listen to what he said.
The most important thing that we do is increase the performance and efficiency of our next generation. So Blackwell is many times more performant than Hopper at the same level of power used. And so that's energy efficiency. More performance with the same amount of power or same performance at a lower power.
Jensen looks at the energy component through the lens of Blackwell's greater efficiency. How do you look at the energy component of accelerated computing?
We certainly are very constructive on the energy efficiency of the future of compute, but we also are constructive on the physical infrastructure aspect of it when we look at how the data centers will be powered, and so much greenfield power is actually needed. So we're quite constructive on the physical infrastructure of it. In fact, if you take a step back and think about the digital infrastructure has actually leapfrogged the physical infrastructure of many developed nations, and we find many interesting plays there as well.
Lei, how do you balance all of this? The chaos around NVIDIA earnings, a single name. All of the central banks speak and all of the economic data in 1 week. What was that like for you and all the things crossing your desk?
Well, that's the excitement about being an innovation investor. We focus on the secular story, the stories that's going to drive stocks, fundamentals, regardless of what central bank will do. So we always go back to, in 2008, iPhone still sold. So irrespective of economic cycle, when we focus on fundamentals, that's what active investment is about. We find stories that will grow irrespective of cyclical backdrop.
So if you're looking active at the moment, and you see the run-up in valuation of certain companies that we've all become completely euphoric around, how do you broaden that out? You said look at the supply side. Am I automatically thinking, okay, go global here, look at a TSMC, look at some of the Japanese suppliers that feed into an NVIDIA? How are you looking at the broader wealth of opportunities that are outside just certain big Mag 7 names?
We go back to the fundamentals. We're active investors. So we look at each company with respect to its own growth opportunity. Obviously, at a high level, we are thematic investors. We look at how big the secular trend is. Then we look at the demand-supply imbalance and the longevity of it. And then we do look at it at a global level and find who are the future winners and losers. Again, go back to, it is a time of change, a time of inflection. And when time of inflection, sometimes we will find the market will underestimate some of the growth opportunities of different parts of the supply chain. And that's what we focus on. One stock at a time, and how strong the growth momentum is, and more importantly, are they going to get majority of the future profit pool? How the industry is being reshaped, that's what we focus on.
You talk about this highway, and everyone is really focused on the infrastructure play, but everyone's trying to work out, particularly the VC community, where the value is in the applications. You talked about healthcare, about advertising already adopting generative AI, but where are some of those long-term opportunities? Where's being undervalued and underappreciated, and where can adopt generative AI?
So at a high level, I would say we're still early. And being an innovation investor, sometimes it does require a touch of imagination, if you will, because the future has yet to come. The future is the best part of it. But I would also point to, we are already seeing, this time is a little bit different. So if you look back the past 15 years, it's about the consumer electronics. You're seeing the killer app. We call them the killer app simply because we can touch and feel. But that said, this one is about the infrastructure upgrade. So it's less obvious, but that doesn't mean the opportunity is not as big. When we look forward, we can see the digital manufacturing. When we think about the reshoring, how much we're going to need on the automation side, and then also the future of robotics. Those are some of the areas that we think we're going to see a lot of great opportunities ahead.
Love having you on to talk us all through your thesis. Lei Chu, Chief Investment Officer of Thematic and Innovation Equities over at AllianceBernstein. Really thoughtful conversation. Meanwhile, coming up, a clash between Brazil and Elon Musk. It's heating up as the country threatens to block X within the next 24 hours. That conversation's still ahead. What are you watching, Ed?
Earnings still happening. There are other names, and one of them is Dell. And Dell is a part of the AI story. It assembles the servers that go into data centers, adds other components, and that helped it with its earnings report in the quarter, gone up 1.4%, which we'll get more on later in the program. This is Bloomberg Technology. win for Elon Musk. There's been a dismissal of a lawsuit claiming he pumped up the price of the Dogecoin into a $258 billion, quote, pyramid scheme. Investors who lost thousands of dollars investing in the coin blamed Musk for promoting Doge or Doge to millions of followers on X. A New York federal judge dismissed the claims, finding that Musk's statements were, quote, aspirational rather than factual and susceptible to being falsified, and no reasonable investor could rely upon them. Meanwhile, a clash in Brazil for Elon Musk. The country's top court justice is taking on Musk's companies as he vows to shut down X and blocked Starlink's bank accounts in Latin America's largest economy. Elon calling the Supreme Court justice an outright criminal of the worst kind. Bloomberg's Kurt Wagner has the job of joining us and explaining what is going on. Let's start there. Kurt, what is going on?
Yeah, so this has been ongoing for a while now. This judge, as you mentioned, Ed, has been trying to get X to take action against certain accounts on the platform, right-wing accounts, misinformation, things like that. Elon, as you know, a self-proclaimed free speech absolutist, is saying, hey, we're not going to do that. We're not going to remove these accounts or adhere to your demands. As a result, he, a few weeks ago, even shut X's operations in the country. Now the judge is saying, well, you need at least a legal representative here in the country in order to operate. And if you don't appoint one, we will remove the app entirely. It sounds like X is not going to appoint someone. So now we're in a bit of a standoff here waiting to see, is this judge really going to follow through and ban X in Brazil?
And this is where Elon Musk's conglomerate of companies suddenly comes to bite him, because this judge isn't taking action just at X alone.
That's right. I mean, this is the universe, the Elon Inc. universe, right? And to get to X, the judge is going through Starlink, which is, you know, Elon's one of Elon's other businesses. And so freezing bank accounts there in order to take money for fines that X owes, right? And so to your point, Caroline, this is a great example of where running 6 different companies, especially in countries where there are adversarial relationships, can really be a detriment to him. And this was something that when Elon first bought X was a real concern. Would there be governments across the world that would apply pressure on Tesla or Starlink or something else, XAI, in order to get to the speech-related issues that happen on X? And we're actually seeing that play out here in Brazil.
Kurt, I know this seems like a very simple, basic question, but what is X's footprint in the country of Brazil? Like, do they have a big office with hundreds of people working there? What are we talking about operationally?
Yeah. Operationally, I believe it was somewhat small compared to a lot of, you know, certainly where they operate in other countries like in the U.S. or even in Japan. I think from a user-based perspective, we don't know exactly. I've seen estimates between 20 million and 40 million active users there. My understanding is it's around the 3rd largest market for them from a user base, behind the United States and Japan. So, you know, significant for sure. Brazil is a country where, you know, people are very active online, very active on social media. WhatsApp is huge there. Instagram is huge there. X is huge there. So this is a significant issue for them. I don't know if that usage necessarily translates to a huge revenue driver for the company, but regardless, the optics, you know, and taking a country of such importance and significance in the world, but certainly in Latin America, off of X entirely is a big deal if this ends up happening.
Now, we're used to Elon Musk firing out on his own platform, but he's got some fighting talk for this Supreme Court justice, in particular saying that ultimately he is an outright criminal of the worst kind, masquerading as a judge. What sort of implications is this going to have for Elon Musk to say that sort of thing?
Well, it's hard to imagine this bridge being rebuilt at any point in the near future, right? I mean, he's sort of going scorched earth here on this judge. I believe he also posted an image that was created by Grok, his AI bot, that showed, you know, the judge behind bars, basically saying you're going to jail, right? I think, you know, when you have someone like Elon who's known to lash out at his competitors, who has almost 200 million followers on X, I mean, these are serious, you know, attacks, right? And we'll see what's going to happen, but I think the bridge there is burnt quite aggressively.
Kurt Wagner, we appreciate it. Thank you. Plenty more. We're going to be thinking about Alibaba next. Stay tuned. This is Bloomberg Technology.